Hello and welcome to the lecture for week number 10. Today our topic of discussion will be on financial derivatives. Specifically, we will be covering call options for shares, put options for shares, and an example on how to use futures to speculate in currencies. But before diving deeper into those topics, let us first have a short overview of what derivatives are. As you can see in the word itself, derivatives comes from derive. So it is something that is derived from something else. In finance, a derivative is an instrument which derives its value, which draws its value, which receives its value from something else. Now that something else is what we call an underlying asset. The underlying asset can really be anything: stocks, bonds, index, interest rates, oil, gold, silver, platinum, precious metals, commodities like soybeans, coffee, steel, etc. Pretty much anything can be an underlying asset. In fact, there are even derivatives for weather conditions. Yes, I am serious. Weather derivatives for temperature, rain, snowfall, etc. This example is only to demonstrate to you that anything can be used as an underlying asset. Anyway, there are three types of derivatives which are the most common: forwards, futures, and options. In this week's lecture, we will be focusing on options. An option, as the name says, is like a choice. It gives you the right, but not the obligation. You have the option to exercise, but you're not obligated. So if you purchase an option contract, whatever the terms and conditions are, you can only choose to exercise them when the situation is favorable to you. But you're not obligated to exercise at all times, under all circumstances. This puts options in a fundamentally different form compared to futures or forwards, because the holder of the option has a discretion. They have a choice of whether to buy or sell the commodity or the asset for which they have purchased the call or the put option. So you notice that I mentioned call and put. Call and put are the two types of options available. Call is associated with buying, and put is associated with selling. So when we say buy or sell, we mean the underlying asset. And the value of the option itself is derived from that underlying asset. The examples that we will be using are related to shares or stocks. Now, a key difference in options pricing compared to futures and forwards is that in futures and forward, there is no upfront price which is paid to the issuer or the writer of a futures or a forward contract. By contrast, in options, whoever issues the option, whoever writes the option, they are to be paid a particular sum, and that is called a premium, an option premium. This is the non-negotiable part of the option. So whatever amount that the seller or the writer of the option determines, the buyer of the option has to fulfill that. So now let's take a look at some of the terminology and characteristics of an option. First, the exercise or the strike price. It is the agreed upon price at which the underlying asset can be bought or sold. This will be clearer to you when we look at a real-life example. The option premium. The price which the option buyer has to pay for the privilege, for the flexibility of having the option. Expiry. It is the date upon which the option expires. After that date, the buyer of the option no longer has the extra flexibility of buying or selling the underlying at the exercise price. Within the call and put option, there are two types depending on the expiry choice: American options and European options. The American option can be exercised at any time up to the option expiry date. So that means, let's say, our call option expires on June the 18th. So anytime from today up until June 18th, if the situation is favorable to us, if the market prices are in our favor, we can choose to exercise them anytime. But on the other hand, in the case of a European option, we can only exercise on the expiration date. Anytime in between, we don't have that option. Now remember, when we say American or European, it does not mean the geographical origin of those. It is entirely possible to have call options with American or European features available from Japan, in Australia, or anywhere. Next, we have long and short. Now, long and short are industry jargon used in the financial community to indicate which position a particular investor or a trader is taking. So when we say that we're going long, that means we are speculating that the price will go up. So that means we will make a profit if the future price increases. So this usually entails buying an asset. Now, on the other hand, going short means that we have a pessimistic attitude about the future price. So the way we will make profit in a short position is when the future price goes down. So that means that we should be selling it now. We should be selling it in advance when the price is high enough. So the short position entails selling. One more thing you should keep in mind regarding options is that when let's say we are an option buyer, when we buy an option contract, we are paying the premium, and through this, we are gaining the right to exercise that option at a future date. As a result, we have a limited amount of risk, because when situations are not favorable to us, we will not be exercising. So our risk will be managed. Our risk will be minimized to a certain extent. But on the other hand, our profit is potentially unlimited. This will be clearer to you when we look at a real-life example. But also, at the same time, I want you to keep in mind the point of view of the option writer or the option seller, which is usually an eminent financial institution or a large investment bank. So when they sell the contract or when they issue the option contract, their payoff is going to be exactly the opposite of ours. Option is a zero-sum game, so somebody's gain is the other party's loss. So because we as an option buyer, we have limited risk and unlimited profit potential, for the option writer, they will have unlimited risk and limited profit potential. I want you to keep this thing in your mind. Okay, next slide. Real life example. For call option. Suppose we pay a premium of $2 to buy a 3-month call option for a BHP share with a strike price of 40. So let's take a look at these numbers. We're paying $2, that is our premium, for the right to have this flexibility. It is a 3-month call option. That means that it will expire in 3 months from today. Now, it doesn't say whether it's a European or an American option, so all we know is it is going to expire in 90 days from today. And the exercise or the strike price is 40. And because it's a call option, that means in 90 days from today, we will have the right to buy the share of BHP from the option seller at $40. Now let's take a look at some of the potential scenarios that might arise out of this option. First, let's say the spot price of BHP on the option expiry date is less than 40. Let's say 38. So in this case, we have no reason to exercise our option. Why should we buy the share of BHP from our option seller at $40 when we can simply go to the market and buy it for 38? It would not make any sense. So in this case, our loss would be our premium amount, whatever amount that we paid to get this option those $2, that would be our loss because we are not exercising our option. So this is the flexibility. We don't have to buy. This is unlike futures or forwards where the contract would be executed. We would be forced, we would be contractually and legally obligated to buy or sell at that pre-agreed price. But because it's an option, we don't have to. We can simply let it go and absorb the $2 of premium loss. Now, scenario number 2. Let's say the spot price, that is the current market price of BHP, in 3 months from now, goes above the $40. That means that we can exercise our option. Why? Because BHP is being traded in the market at above 40. So we don't actually have to buy at 40. We can simply trigger the option. We can tell our option seller that, please, as we agreed upon before, give me those shares for $40. This was our deal. So we buy those shares from them at $40 and then sell them at the general market or the stock exchange for the prevailing market price of, let's say, 41. So we gain $1 extra of profit because of our option. Let's look at it at a little bit more details. Suppose the spot price in 3 months goes up to 48. So our gross profit here is going to be 48 minus 40 because we will be triggering the execution clause or the exercise clause of our option. We are in a profitable situation. So our gross profit would be the difference between the market price and the exercise or the strike price, $8. But do not forget that we also incurred a cost of premium. We acquire these options for those $2 that we paid. So we also have to account for that. So shaving off those $2 from the gross profit, we arrive at a net profit or a net payoff of $6. Now we can do the same thing. We can keep repeating this for many different price levels, and we can arrive at an answer of how much our expected payoff will be. So for $40 or below, we will not exercise our option. Our loss will be limited to the premium, which is $2. At 44, we break even. Our break even would be at 42. At 48, our payoff is $6. At 52, it's $10, so on and so forth. Let's visualize this. So you see on the left-hand side image, that is our position as a buyer of the BHP call option. So you see up until 42, our break-even point, below that we don't make any profit. So $42 and above, our profit potential is pretty much unlimited. The more prices go up, the more profitable our option becomes. But anything below 42 on the left-hand side of 42, you can see that the loss is capped at $2. Under no circumstance do we lose more than $2. So this is extremely useful as a risk management tool because it caps our potential loss. Our risk is managed, but our profit potential is unlimited. But at the same time, as you recall, it is a zero-sum game. So from the option writer's point of view or the option seller's point of view, the entire graph will be flipped. So whatever is our profit potential would be their risk or their loss potential. And whatever is our risk will be their profit. So you can see that any price below 42, we are losing money, but our risk is capped. But for them, this is the profitable situation, 42 and below. And anything beyond that, they are losing money. Now that example was for call option. Put option gives you the right, the flexibility, the choice to sell the underlying. Call option was for buy, put option is for sell. So let's flip around the previous example. Let's say if we pay $2 to obtain a 3-month option for a BHP put, that is, we can sell those shares for $40, what will happen? Now, because it's a put option, we are having the choice to sell those shares at $40. So the only way we would be in profit is if the price goes below 40, because now we are selling first with our option writer. So in 3 months from now, if the market price remains at 40, our payoff is going to be $2 because the price did not change and the premium is our loss. Price goes anywhere above 40, there is no reason for us to exercise. Why? I can go to the market and sell it for 40. Why should I sell it at a lower price to my option seller? Now, when we go below 40, 38, 36, 32, and so on, our profit starts to rise. In this case, accounting for the $2 of option premium, our break-even point would be $38. But when we go down to, let's say, 32, our gross profit becomes $8, 40 minus 32, but accounting for the premium, the net profit or the net payoff is $6. Let's visualize this in graph. It's the opposite scenario of the call option. Our profit potential is no longer unlimited. On the right-hand side, you will see that we make profit at any rate below 38. So the profit keeps rising all the way down to when share prices become zero. I mean, technically, prices do not go to zero, maybe 1 cent or 2 cents, because at zero, you're basically giving away your share for free. So there's no reason anyone would buy or sell. But anyway, the profit potential would be capped up until the price of the share goes down to $0. But on the flip side, when prices go above 40, our loss is capped at those $2 because we will not be exercising. We have no incentive to sell at a lower price than the market. Of course, the entire thing would be flipped for the option writer's point of view. And you can see on the left-hand side that they're losing money when the price goes down. But when prices go above 38, they start making money.